Jay Coulter here at the Exchange ETF conference in sunny South Florida. I'm here with Luke Oliver. Before we get started, a series I produced called ETF Stories has been really popular because we let issuers come on and tell the story of their ETF. It's not even a veiled pitch. We go deep on how that ETF is built and where it belongs in a portfolio. By far, the most downloaded and watched show was when Luke came on to talk about the carbon ETF, KRBN. So we're definitely going to get into that. But Luke Oliver with KraneShares, tell me, what's new in your world?
In my world, well, KraneShares, lots going on. You know, our China focus has done very well despite market performance and some of the headwinds there. We've seen great asset flows into China. People are starting to really get that. The carbon side, lots of exciting things. Carbon, we've had some volatility. It hasn't changed our view, and happy to kind of dig into that more. We've also launched what is the ultimate kind of complement product to KRBN. KRBN, of course, gets you long the price of carbon. Being long the price of carbon is going to decarbonize the economy. You need to be long the right stocks. So we've launched an active equity fund that actually gets you long those stocks. So the two of these things together is the way to get long decarbonization, which is the biggest trend of the next 10 years.
Absolutely. So let's get started with the new offering. Tell us about is it an ETF?
It's an ETF.
Tell us about it.
It's an ETF. So KRBN, futures-based along the carbon markets. KGHG, GHG for greenhouse gas, easy to remember. K for crane. KGHG. So it's the Global Carbon Transformation ETF, global equity, actively managed. We have a great manager, Roger Mortimer's joined us, 5-star Morningstar rated manager, fantastic history in the industry. And he is picking the companies that might not be the greenest companies, might not be the cleanest companies, but these are the companies that have the most change to make and are dedicated to making that change. So we're buying, an example would be Fortescue. It's an Australian mining company digging iron ore out of the earth. No one wants that. No one in ESG wants that. It's a value stock, not interesting legacy industry. But it's a mining company. It's great at global infrastructure projects and shipping that produce across the world. And suddenly they're looking at their situation in the Australian desert. They've got sun, they've got wind. They're creating renewable energy, not to sell that energy, but to create scalable green hydrogen. So the market's pricing that as an iron ore miner. One day soon, that caterpillar is going to turn into the butterfly, and we're going to have a global energy leader in green energy. And so that's what this portfolio is about. Who's going to have the most impact, and who's also going to be one of the best investments to have in this. And think about, we've got 20% of the global economy has to do a full 180 over the next 10 to 20 years. And these are the companies that are going to pick that up. So long carbon and long KGHG.
Yeah, that sounds like another innovative offering from KraneShares.
Oh, yeah.
I'd like to go a little deeper on that. Any U.S. companies that you could speak to that fit that parameter?
Who have we got in the U.S.? We've got some chemical companies in the U.S. And like I said, some of these companies are not necessarily it's funny, a few people have looked at it and said, wait a minute, this isn't ESG. And we've had journalists call and say, we're going to write a story about this isn't an ESG fund. And we didn't claim and never would that it's an ESG fund. But if you're an ESG investor, this is the kind of fund that is having the sort of impact that you want to achieve. So it's a very interesting sort of way of looking at this. We think that, as we hear people kind of maybe pulling back the energy crisis, pulling back a bit from ESG or questioning whether ESG exclusion is the right way to go, this fund isn't trying to be anything other than a fund that gives you that direct exposure to the companies that are going to decarbonize the economy. So it's a really important distinction. It doesn't mean it's clean or green. It's going to become clean and green and have the most impact in the global economy in doing that, which we think is more important.
Really interesting take on ESG. It's more like you're playing the long game to unlock long-term value for people who are making that transformation.
Yeah, I would even go as far as ESG looks to buy and maybe reward the good, clean companies. What we want to do is incentivize the dirty legacy companies to improve. And I think that gets you, it unlocks their capital to scale and get this innovation flywheel going where they invest in something, makes it scalable. That starts to make the money, makes it even more scalable. And suddenly we get real movement, not just buying clean, green, tech companies that exist today. So it's investing in a problem, not buying things that are already solved. So
excellent.
It's an important distinction.
All right, let's circle back on carbon.
Yeah.
If you want to watch the first episode, go to etfstories.com. But the comments that we get on that actual show I find very interesting. People are confused about the space. How can you actually invest in carbon credits? What does that even look like? For folks that are just now hearing about it, Look, how do you invest in carbon credits?
Well, this part of the issue is that it's a market that is somewhat institutional in that you have to access it through futures or directly into the underlying markets, which is quite difficult to set up bespoke infrastructure to do that. So the futures are accessible, but really only at an institutional level. So we package those futures in a traditional 1940 Act ETF, trades like a stock, like any other ETF that the conference is focused on. And it's very simple. So anywhere you can trade equities, you can buy KRBN. It's not a K1 ETF. It's a 1940 Act. You get it on your 1099. And so it's as simple as your S&P 500 ETF, except it's getting you exposure to something that is, and this is what's so unique. And obviously we go into that more detail on the other video, but it's a market that is designed to increase in value in order to de-incentivize pollution. So essentially you're long climate regulation. And we know that regulation's tightening. And even in the face of the climate, the energy crisis that we're involved in, the European Union especially is doubling down on their efforts to continue reducing emissions. So you're able to get along with this fund, a basket of Europe, California, Northeast US, as well as the UK, and maybe one day South Korea, China, and others, their regulation. So as regulation tightens, you're literally long that regulation. And for us, we see very low correlations to everything else, potentially an inflation hedge. As this ramps up, it's going to be a cost on the global economy. And then lastly is just this idea that there's price discovery and we're nowhere near where this needs to be priced to actually reduce emissions. So if the policy objective is to reduce emissions, they are going to enforce that price to reduce emissions, and we're not there yet. So we see, very, very exciting risk return considering asymmetrically it's supported to rise. So you've got some asymmetry there that's constructive, and we think the price should be a lot higher. And so for context, the average price in the fund is about $45 per ton of carbon. So if you're a power station and you're emitting carbon, you're burning coal, you need to buy these. You must buy these by law. By being long, we're supporting that price. And the average price is about $45 in the fund. Most targets are $100 to $150 a ton. And that's in the next couple of years. And it needs to be there in order for us to hit Paris Agreement, 1.5 to 2 degrees of warming. So this is really topical, completely correlated to the efforts to reduce climate change. And so you've got that impact element as well. So when you talk about, asymmetric potential, potentially very high returns as you see price discovery, low correlations, and its impact. And I think that's really compelling. And then when you pair that with the new fund that buys the companies that benefit from that, it gets quite interesting.
I'll tell you, our first interview on this, it was a learning exercise for me. And my big takeaway back then is the same as now. It's a way to go long regulation.
Long regulation, and it's tightening. And not only do we think it's tightening, it's been forecasted. The agencies running this regulation are saying our aim is to significantly reduce supply of these credits in order to push the price higher, in order to reduce emissions. And the idea that we get to be long and do that through an equity as we structure with the ETF, it's pretty incredible. It really is. It's a privilege for me to be able to talk about it and talk to clients about it.
So when you look at a traditional futures-based fund, they run into contango and backwardation issues. Does that present itself in these markets?
It does, but not in. It's a great question and it's a valid concern, but it's about 200 basis points, so 2%, meaning that the futures that we're buying, if the market doesn't move, over time, they're almost falling down 2% over the period of a year. So in oil, people worry that you buy something, you're right, you buy oil, it goes up, but you still lose 20% because of contango, because of the cost of storage, the cost of transport. This is a permit, so there's no storage, there's no transport. So it's not like a commodity where you have this excessive contango risk. So it exists, but it's about 2% in KRBN, which is the flagship global blended product.
Awesome. Anything else that investors should know about KRBN before adding it to a portfolio? And as a follow-up, where does it fit in a portfolio?
Right. Well, so despite everything I said, which I think are very compelling, it is volatile. It's more volatile than equities. From a sharp perspective, it's been more attractive than equities, but double the volatility, more than double the returns over historically. So it's very interesting. It is a diversified, but it is volatile. No, I would never want to suggest. I think it can lower the volatility of your portfolio because of all those correlation benefits, but it is volatile in its own right. And then where in the portfolio, sort of the thematic part of the portfolio that we see growing in advisors' portfolio fits very well there. If you have commodities, this is a great commodity replacement. The commodities do have the contango problem. They're not green or impactful themselves. In fact, you might be hindering by buying commodities, but by being long carbon instead, perhaps you're having a positive effect there. So great commodity replacement, great alternative. It's got all the hallmarks of an alternative: low correlations, asymmetric returns, and all of these kind of things. So alternatives or in the thematic. And what's interesting is a lot of people I've talked to, they want to add this, but they're not just going to fund it from their equities or their risk asset. They're going to be more maybe funding it from their fixed income, which doesn't mean you get the risk reduction as much because you're adding something riskier, but because of those correlation benefits, it doesn't get any worse. Mm-hmm. So I think that's kind of interesting. So we're seeing a lot of people using it different ways. We're seeing a lot of pensions using it as an inflation hedge, which I think is really interesting. That's and that was something that clients brought to us. So, we like this for the inflation hedge perspective, and that was and now that's one of the key points we talk about.
Do you have any responsibilities at KraneShares for the Chinese products?
Oh, we all are. That's our company is founded on that focus on China. And the way I look at it is climate and China, which are our two main pillars of the business, are going to be tied together because China is the world's largest polluter. China is focused on very aggressively reducing its carbon footprint, contrary to what sometimes we hear. They're just a little behind the curve versus the Western world. So yeah, very much focused on China. KWEB is our flagship fund. It's been incredible. We've seen the amount of flows into KWEB over the past year, despite political risk in the US, political risk in China itself, regulation, and lots of uncertainties. We're seeing a lot of flows going in there.
Let me stop you right there.
Yeah.
KWEB. Break it down for folks that aren't familiar with the
fund. So KWEB is Chinese internet, and it's the it kind of really sits at the heart of what we see as the opportunity in China, which is this burgeoning middle class, growing middle class, rising consumerism, and the companies that are the best transmission for that are these internet companies. We're talking about Alibaba, we're talking about JD, Tencent. All of this technology is some of the biggest drivers of the Chinese economy. So we almost feel like this is the proxy for the most important, fastest growing part of the Chinese economy. And as we know, we've got many of these companies listed in the US. We're seeing them moving back to Hong Kong, and we've actually, most of the liquid stocks in Hong Kong, we've moved to the Hong Kong listings. And that takes off the table some of the concerns people have about the political risk. Will Chinese companies be able to list in the US? That's why you invest in KWEB, because you don't have to worry about these companies being delisted. We're managing that inside the fund. So I think that's quite important as well. We have an institutional capability to manage where these stocks are listed. Mm-hmm. And that's something people don't forget. They think, well, I can buy JD and I can buy Alibaba on the New York Stock Exchange. Why do I need an ETF? Well, one, it's not just those two stocks. We're holding the full basket. And we're also managing the political risk side of it. And of course, and the research we do, Brendan Ahern and the rest of the team put out incredible China research.
So something that I think is going to become an issue down the road is when financial advisors are building out their global allocation, do you separate China from the rest of the emerging markets?
You have to, and you should be. Not everyone's doing it yet. And that will absolutely happen. There's no way that doesn't happen. When it happens and when people get comfortable, there's still so much. We still meet a lot of people who just go simple. They put money with an emerging markets manager and they rely on that manager to give them their China allocation. The problem is most of the indices aren't designed to hold China at its correct weight because of all these different listing venues. You've got Hong Kong, you've got New York, you've got Chinese mainland. Chinese mainland is accessible now, but the indices haven't caught up yet. And that's a big part of the China story, is that global asset management hasn't yet fully invested in China. And so there's an inclusion story. As those indices add those stocks, there's going to be huge flows into Chinese equities. And there's no reason to wait for that to organically happen when you can go and invest in China through our KBA, that's your onshore China, KWEB, that's the Chinese internet stocks. And we've got we've got Chinese clean tech. We've got and we also have a thematic suite that also kind of focuses on China, like our electric vehicles ETF, but it's also global electric vehicles. So there's a lot of ways to skin the cat and get exposure to China. You don't have to wait for the legacy indices to catch up. There's no reason to do that, and we think that's where there's a lot of edge to be had for financial advisors, breaking that out and actually showing their clients the benefits of that standalone allocation.
Yeah, I agree 100%. And I think that's going to be the standard at sometime soon.
It's no doubt.
Yeah. So to learn more about all the KraneShare offerings, visit KraneShares.com. That's KraneShares.com. Luke, thanks so much for coming back on.
Thank you. It's been great.